To grasp the true scale of the disaster confronting the banking cartel this Monday, we must first examine the anomaly that unfolded late Friday afternoon for 4 decades. The so-called Friday smash has been the most dependable weapon used by bullion banks. The method is cold, automated, and ruthless. They flood the futures market with billions of dollars in paper sell orders just minutes before the closing bell, triggering stop losses and crushing investor confidence ahead of the weekend. They deployed this exact playbook on Friday. Major banks and swap dealers dumped an enormous volume of short contracts, aiming to force prices back down toward the $62 level. But then something unprecedented occurred. The price refused to break. Instead, it slammed into an unseen wall of buying pressure so powerful that it absorbed the entire selling wave within seconds. The algorithm failed. The smash was decisively rejected by the market, and silver surged into the close at a multi-year high. This was not a random market fluctuation. It was a flare in the night sky, signaling that the manipulators have exhausted their ammunition. The very tool they relied on to crush prices has shattered, leaving them exposed to a market that now recognizes their weakness. As the Asian trading session approaches, market participants are preparing for a phenomenon known as a gap up. Under normal conditions, prices move smoothly and continuously. But during moments of crisis, price action becomes discontinuous. A gap up occurs when demand is overwhelming and available supply is virtually non-existent, making it impossible for the market to reopen at Friday's closing level. Instead, price must leap higher to locate the first willing seller. Given the violent reversal seen on Friday, quantitative models suggest silver will not reopen near $67. Projections indicate a direct jump towards $75 or beyond. This creates a psychological vortex. Traders who held short positions over the weekend expecting gains will wake up Monday morning effectively bankrupt. There will be no opportunity to exit and no chance to hedge. The gap will bypass stop-loss orders entirely, leaving traders with catastrophic and unrecoverable losses. This is the nightmare scenario for the largest bullion banks, and it is unfolding in real time. The key force behind this impending explosion is the complete evaporation of sell-side liquidity. We are entering what is known as a no-offer market. In typical conditions, every buyer is matched with a seller. But after Friday's overwhelming show of strength, who would willingly sell silver near $68? Mining firms have withdrawn their hedging activity. Institutional investors are holding firm. Sovereign funds are quietly accumulating. The result is a vacuum when trading algorithms activate on Monday morning, frantically attempting to buy back short positions to stem the losses. They will encounter an empty marketplace. Cash will be waved in desperation. Offers will be shouted into silence, and the market will not respond. When a forced buyer with unlimited downside meets a market with no sellers, prices do not rise gradually, they accelerate violently. The price accelerates vertically until it reaches a level where greed finally overwhelms fear, likely well beyond $100. The fuel igniting this surge is a technical phenomenon known as a gamma squeeze. This mechanism operates through the options market, which has expanded to unprecedented size. Speculators and hedge funds have accumulated enormous volumes of call options with strike levels at $70, $75, and $80. The banks, serving as market makers, are the ones who sold these contracts as the spot price climbs toward those strike levels. The banks are legally and mathematically obligated to purchase silver futures to hedge their exposure. The higher the price climbs, the more they are forced to buy. Their own hedging activity drives the price even higher, compelling further purchases just to remain neutral. This creates a vicious positive feedback loop. On Friday, they attempted to smash the price lower in a last-ditch effort to escape the gamma squeeze. They failed. Now, heading into Monday, they are pushing themselves into a self-destructive buying spiral that threatens to launch prices into the stratosphere. This brings us to the uncomfortable question everyone is avoiding: the solvency of the largest bullion banks. These institutions hold the most extreme derivative short positions ever recorded in the commodities market. These positions are not strategic investments. They are naked wagers that silver would remain suppressed. If silver stays near $25, they collect profits. If silver climbs to $75, they lose billions. If silver reaches $100, many of them become technically insolvent. The margin capital required on Monday alone exceeds the liquid reserves available within their commodities divisions. This reality helps explain the system glitches and service outages that have recently surfaced across the banking sector. They are attempting to conceal the truth that the emperor has no clothes. Monday is not merely about the price of a metal, it represents a stress test for the entire Western financial structure. If control over silver is lost, the shock will cascade into gold, spill into the bond market, and ultimately undermine the currency itself. While Western markets continue to shuffle paper claims, The East is quietly absorbing the physical supply. The Shanghai Gold Exchange has been pricing silver at a premium of roughly 12 to 15% above the New York futures market. This price difference is the engine accelerating the physical shortage. Why would a mining operation in Mexico ship silver to New York at $67 when it can send it to Shanghai for $78? It wouldn't. As a result, physical metal is flowing steadily eastward, draining Western vaults. When trading begins on Monday, Chinese buyers will sense the vulnerability in Western markets and likely intensify their accumulation, stripping remaining eligible inventory from futures exchanges. China is not simply observing this squeeze from the sidelines, they are actively shaping it. They are effectively cornering the market for the technology metal of the 21st century, turning the West's own corruption into a weapon against it, and the banks are no longer the only ones in panic mode. Industrial titans such as Tesla, Samsung, and Apple operate on just-in-time inventory models. They depend on silver for semiconductors, solar technology, and battery production. For years, they observed price suppression and assumed silver would remain inexpensive and abundant forever. That belief was shattered on Friday. Now, procurement managers across these corporations are scrambling. Without access to silver, production lines grind to a halt. As Monday approaches, panic buying from the industrial sector is expected. These buyers are indifferent to price. Their concern is survival. They will bid aggressively, outcompeting the banks and pouring even more fuel onto the fire. We are transitioning from a financial market into a scarcity-driven market, where ownership itself becomes the ultimate rule. Traders must also consider the so-called nuclear option. If prices gap upward toward $80 or $100 on Monday, the futures exchange could invoke force majeure. This emergency provision allows exchanges to rewrite the rules when markets spin out of control. Trading could be halted entirely, buying could be restricted to close-only positions, meaning traders may sell but are prohibited from opening new long positions. This playbook was already used during the nickel crisis of 2022, when explosive price action forced exchanges to cancel billions of dollars in trades to protect a single powerful player. There is no reason to believe they would hesitate to do the same to shield a major American bank. Yet declaring force majeure in the silver market would be an act of self-destruction. Silver is not just a commodity, it is money. If the silver market is broken, global confidence in the dollar evaporates instantly. Policymakers are trapped between two impossible choices: allow the bank to fail or allow the currency to fail. Retail investors also cannot be ignored. The silver squeeze movement has evolved. These are no longer fragile holders who panic at the first pullback. These investors are driven by ideology and deep mistrust of the banking system. On Friday, when prices dipped, they did not sell, they accumulated more. That behavior shattered the bank's algorithms, which depend entirely on fear to function. But fear has vanished from the retail crowd. They sense weakness. They smell blood. On Monday, millions of individual investors stand ready to surge into the market, forming a swarm that institutional players can no longer suppress. The psychological shift is complete. From fear of loss to fear of missing out, FOMO has taken over. The herd is moving, and the gatekeepers are being trampled. We are standing on the edge of a historic moment. The chart has turned vertical. Short sellers are trapped. Physical silver is disappearing. Black Monday of 2025 will not be remembered as a crash, but as the day the true price of silver was finally unleashed. The initial gap towards $75 is only the opening act. If momentum persists, triple-digit prices could emerge before the month ends. Caution is warranted, however, as volatility will be extreme. The system will resist violently before surrendering. But one fact is undeniable: the Friday smash failed, and the era of manipulation is breaking apart. The transfer of wealth from paper holders to metal holders has now officially begun. The countdown is underway. Monday is approaching. Are you prepared? The global financial system witnessed an event on Friday that defies the established rules of modern banking manipulation. For 4 decades, the pattern has been predictable. Whenever silver shows signs of breaking free, bullion banks, with JP Morgan at the forefront, unleash massive sell orders to drive prices back down. This tactic is known as the Friday smash. Its purpose is psychological warfare, designed to crush confidence and push traders to sell before the weekend. They attempted the same maneuver again this Friday. Billions of dollars in paper contracts were dumped onto the market, algorithms were activated, media narratives were deployed, and then the impossible occurred. The hammer did not rebound, it broke apart instead of collapsing. The price absorbed the impact and surged sharply higher. The market closed with silver at a multi-year high, leaving the banks trapped in short positions that are now bleeding hundreds of millions of dollars with every passing hour. The hunter has become the hunted. As the weekend sets in, fear is spreading rapidly across trading floors in New York and London. They understand exactly what lies ahead. When Asian markets open on Sunday night, marking Monday morning in the East, a gap up becomes mathematically unavoidable. A gap up happens when buying pressure overwhelms the market and sellers vanish entirely, preventing price from moving in a smooth progression. Instead, price jumps instantly from Friday's close near $67 to $75, or beyond in a single move. For retail investors, this represents an extraordinary windfall for banks holding short positions. It is a death sentence. A $10 gap higher on Monday morning would erase an entire quarter's profits for a major trading desk in seconds. This is no ordinary trading session. What we are witnessing resembles a crime scene.